Before we break this down, this isn't financial advice for your portfolio. It's my analysis for educational purposes. Right now, something's happening in the housing market that should make every American homeowner and renter pay attention. While everyone's debating whether we're heading for a crash or soft landing, the data is showing patterns that look similar to what happened right before 2008. But this time, it might be worse. Home prices are now less affordable than they were at the peak of the 2006 housing bubble. Let that sink in. We're in worse territory than right before the last crash. Yet most people think everything's fine. The median home price has shot up 40% since the pandemic started, while wages have barely budged. But here's the thing. This isn't your typical housing bubble story. What's building up right now is something different, something that could affect millions of Americans whether you own a home or not. Existing home sales just hit their lowest level since 1995. That's not a typo. We're talking about 30-year lows. Meanwhile, 82% of homeowners with mortgages are sitting on interest rates below 6%, which means they're essentially trapped in their homes. They can't sell because buying something new would double their monthly payment. This creates what economists call the lock-in effect, but here's what they're not telling you. This same phenomenon is creating artificial scarcity that's keeping prices inflated at dangerous levels. It's like musical chairs, except most of the chairs are occupied by people who can't move, and everyone else is fighting over what's left. The average American now needs to earn $114,000 a year to afford a typical home. The problem? The median household income is only $70,000. That gap isn't sustainable, and when unsustainable things exist in housing markets, they eventually correct themselves, sometimes gently, sometimes not. There are three specific patterns emerging that should make every American nervous. First, we're seeing what happened in 2006 all over again. People are stretching themselves financially to get into home. The difference is that back then, banks were giving out loans to anyone with a pulse. Today, buyers are technically qualified, but they're using every dollar of their income to make it work. Second, the rental market is becoming just as unaffordable as buying. When people can't buy homes, they rent. But now rent prices have exploded too, trapping millions of Americans in a cycle where they can't save for a down payment because they're spending 40% or more of their income just on rent. Third, and this is the most concerning part, institutional investors and corporations are buying up massive amounts of residential property, not to live in, but as investment vehicles. When Wall Street starts treating housing like a commodity instead of homes for families, it creates price distortions that hurt regular people. These investors can afford to pay cash and outbid families, which keeps prices artificially high. Everyone keeps saying this time is different, and we won't see 2008 again. They're right. This time could be worse in some ways, better in others. It could be worse because the affordability crisis is deeper. Back in 2008, people were losing homes they never should have been able to buy in the first place. Today, people who should be able to afford homes simply can't. That's a much broader problem that affects the entire economy, not just risky borrowers. The job market, savings rates, and lending standards are stronger now, which should provide some cushion. But here's what's really different. The solutions that worked in 2008 aren't available anymore. When the housing market crashed in 2008, the Federal Reserve cut interest rates to nearly zero and kept them there for years. That's not possible now because rates are already relatively high due to inflation concern. Mortgage rates are sitting above 7% and aren't expected to drop significantly anytime soon. When rates are high, fewer people can afford to buy, which means less demand, which eventually means lower prices. But there's something else happening that didn't exist in 2008. Climate change is making certain areas of the country less desirable or even unlivable. Insurance costs are skyrocketing in Florida, California, and other states due to natural disasters. This is creating regional housing markets that could collapse independent of national trends. Here's what this means for you, whether you currently own a home or not. If you own a home, you're probably feeling pretty good about your net worth right now. Your house is worth more than you ever imagined. But here's the reality check. That wealth is only real if you can access. If you sell your house, where are you going to live? Everything else is expensive too. You're rich on paper, but potentially trapped in practice. If you're trying to buy a home, you're experiencing this crisis firsthand. You're competing with investors who have cash, you're stretching your budget to the breaking point, and you're probably wondering if you should wait for prices to come down. The honest answer is that nobody knows exactly when or how much they'll drop, but the current situation isn't sustainable. If you're renting, you're caught in the middle. Rent keeps going up because there aren't enough homes for sale. but you can't save for a down payment because rent is eating up all your money. You're essentially funding someone else's investment while your own financial future gets pushed further out of reach. Here's what's really concerning. This housing affordability crisis is starting to affect where people can live and work. Teachers, firefighters, nurses, and other essential workers are being priced out of the communities they serve. That has consequences for everyone, not just the people being forced to move. Housing isn't just about having a place to live. It drives massive parts of the American economy. When people can't afford homes, they don't buy furniture, appliances, or hire contractors for improvements. They don't feel secure enough to start families or change jobs. This has ripple effects that touch every part of the economy. Consumer spending, which drives about 70% of economic growth, depends heavily on people feeling confident about their housing situation. When housing costs take up 40% or 50% of someone's income instead of the recommended 30%, they have less money to spend on everything else. Restaurants, retail stores, entertainment venues, they all feel the impact. There's also a generational wealth transfer happening that most people aren't talking about. Homeownership has traditionally been how middle-class families built wealth and passed it to their children. When young people can't buy homes, they can't build that wealth. Meanwhile, people who already own homes are seeing their wealth increase. This is creating a growing divide between the haves and have-nots that goes beyond just housing. Small businesses are struggling too. When their employees can't afford to live nearby, they have trouble finding workers. When their customers are spending most of their money on housing, they have less to spend on goods and services. This creates a downward spiral that hurts economic growth. Nobody can predict exactly what will trigger a housing market correction, but there are several scenarios that could push things over the edge. A significant economic recession that leads to widespread job losses would force many homeowners to sell, even at a loss. Unlike 2008, most homeowners today have equity in their homes, so they wouldn't necessarily face foreclosure, but they might need to sell to access cash or relocate for work. A major shift in remote work policies could redistribute demand across the country. If companies start requiring employees to return to offices, it could crash housing prices in rural and suburban areas that boomed during the pandemic while putting even more pressure on expensive urban markets. Interest rates staying high for longer than expected could gradually price out more and more buyers until demand collapses. This is actually the most likely scenario. A slow squeeze rather than a sudden crash. Climate events and insurance costs could make certain regions uninvestable practically overnight. We're already seeing early signs of this in parts of Florida and California. So what can you actually do with this information? If you own a home and you're happy with it, the smart move is probably to stay put. Enjoy the equity you've built, but don't count on it continuing to grow at these rates forever. If you are thinking about selling and trading up, run the numbers carefully. That bigger house might cost you significantly more per month than your current mortgage. If you're trying to buy a home, patience might be your best strategy. This doesn't mean waiting for a crash. That might not happen, or it might not happen in your area. But it does mean being realistic about what you can afford and not stretching yourself too thin. The last thing you want is to buy at the top of the market with a mortgage payment that leaves you no room for emergency. If you're renting, focus on building your savings and improving your credit score. When the market does shift, and it will eventually, you want to be ready to take advantage of better conditions. For everyone, the most important thing is to stay informed about what's happening in your local market. Housing is intensely local. National trends matter, but what happens in your city or town is what will actually affect your life. The housing market has always been cyclical. Prices go up, then they stabilize, or go down, then they go up again. Right now, we're in an extreme part of that cycle, which means change is coming. The question isn't whether things will shift, it's when, how much, and whether you'll be prepared when it happens. The warning signs are there. The question is whether enough people will pay attention before it's too late to adjust their plans accordingly.